Welcome! In this video, Zbcn coin can increase 560% this year. What is the reason? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand. One of the most striking structures we encounter when examining price movements in the market is the ascending curved channel. This structure shows that the price is moving upward over time with a certain slope, and that this movement takes place within a specific channel. The most important feature of the ascending curved channel is that its lower and upper bands are not parallel but curve slightly upward. This indicates that we are talking not only about a linear uptrend, but also about an accelerated upward movement. While the price moves within this channel, it sometimes finds support by touching the lower band, and sometimes encounters resistance by touching the upper band. The current situation is particularly noteworthy because the price has touched the lower band. This touch is quite significant in terms of technical analysis. Touches to the lower band often indicate that the price may change direction and start accelerating upward again. This is the point where buyers step in and add a new wave of demand to the market. In ascending curved channels, such lower band touches are often seen as strong buying opportunities because the general trend is upward and lower bands act as safe zones within the trend. The price touching the lower band right now may indicate that short-term downward pressure has eased and buyers are re-entering the market. In this case, the potential for the price to move toward the upper band is quite high. Reaching the upper band could mean a significant rise from the current price level. Moreover, this may not just be a short-term reaction, but also a continuation move of the trend. Ascending curved channels generally appear in bull markets. In such market conditions, each lower band touch reinforces the market's tendency to make higher highs. Investors often wait for lower band regions to buy within such a structure. The reason is that the risk-reward ratio is more favorable in these areas. In positions taken from the lower band, stop-loss levels can be determined more clearly and potential gains can be higher. In addition, the movement from the lower band to the upper band often happens more quickly. This is because the buying pressure that forms at the lower band can trigger a strong upward move in a short time. Market psychology also plays an important role in such channels. Touching the lower band is perceived by many investors as a buy zone. Therefore, buying orders tend to accumulate immediately after this touch and the price starts accelerating upward. The upper band of the ascending curved channel is, in a sense, the ceiling area of the market. When the price reaches this area, usually profit-taking begins and a certain pullback occurs. However, since the main trend is upward, these pullbacks are mostly limited. Therefore, in the current scenario, it is technically quite reasonable to expect the price to move upward from the lower band and reach the upper band. Looking at the mathematical structure of the ascending curved channel, price movements increase with a certain momentum. This momentum can be understood from both the slope of the trend lines and the wavelengths of the price. The lower band represents the base level of this momentum, while the upper band represents the point of maximum speed. When the price reaches the lower band, momentum indicators often give signals in oversold regions. In technical analysis, this can be considered a confirmation for a buy signal. In addition, volume analysis is important at this point. Increasing trading volume during lower band touches indicates that the upward move may be strong, because higher volume shows that new money is flowing into the market. When all these factors come together, the probability of the price starting an upward move from the lower band in the current situation strengthens. The point to watch here is that the lower band support is not broken. If the price closes below the lower band, this may technically indicate that the ascending channel is broken. However, if there is no such sign of a breakdown right now, the main scenario is for the price to head toward the upper band. During the move toward the upper band, it is important for the price to break through intermediate resistances and maintain its momentum. Especially if the trend continues, it is also possible for the upper band level to be broken. In this case, the channel may expand further and the price may accelerate to reach much higher levels. In conclusion, support taken from the lower band within an ascending curve channel is interpreted in technical analysis as a strong bullish signal. The fact that the price is currently right at this point shows that the upward potential could be quite high in the coming period. When market psychology, technical structures, volume dynamics, and trend direction come together, the likelihood of the price reaching the upper band is both logical and technically supported.
In scenarios where the trend is intact and buyers are strong, it is common for the price to move quickly and strongly upward after such lower band touches. Therefore, the current technical outlook is promising and paints a positive picture. But we can't make a decision based only on the curve. Let's take a look at the other metrics as well. Keep watching.
A rise in the ATR indicator is one of the strongest technical signals that market volatility is about to increase. ATR, or average true range, is an extremely valuable tool that measures how wide a range price movements are occurring in, allowing investors to determine whether the market is calm or active. An increase in ATR value indicates that the price is moving within a wider range in a short period of time, signaling the potential for sharp moves in both upward and downward directions. Such situations, especially when combined with the trend direction, signal that the price could make significant breakouts and that investors may need to make quicker decisions. High ATR means that trading volumes among market participants are increasing, investors are opening more aggressive positions, and price is reacting more strongly at support and resistance zones. Therefore, an upward move in ATR shows that the market is losing its stagnation and sharp fluctuations are on the horizon. An ATR rise usually appears when the price is breaking out of consolidation phases or after important news releases, economic data, or technical pattern breakouts. Low ATR levels indicate that the price is stuck in a narrow range and investors have not determined a clear direction, while a rising ATR indicates that this range has been broken and that the price will now move faster and within wider ranges. This increased activity often presents significant opportunities for investors as, with higher volatility, the time needed to reach price targets shortens. If the price is already in an upward trend and ATR is rising, this often means that the uptrend will gain momentum and sharp upward moves could occur. In other words, a rising ATR can indicate not only that the movement will speed up, but also that the trend is strengthening. The key here is to correctly interpret the direction of the ATR and its relationship to the price chart. A rise in the ATR does not always mean the price will move in one direction. It only shows that volatility is increasing. However, if this rise is combined with a strong technical breakout, price movement above an ascending trend line, or the breach of a critical resistance level, then a rising ATR indicates that the price could quickly reach its targets. For example, if the price breaks out of a triangle formation to the upside while ATR spikes sharply, this usually signals the start of large buying waves and that the price can increase significantly in a short time. When ATR rises, it can be said that both buyers and sellers are much more active in the market. This leads to increased liquidity and faster price reactions. In markets such as cryptocurrencies, commodities, or stocks prone to high volatility, ATR increases can lead to much more dramatic outcomes. Investors should closely watch both opportunities and risks during such periods. This is because while increased volatility raises profit potential, it also brings the risk of sudden price reversals. Therefore, a rise in ATR requires more precise determination of position sizes, stop-loss levels, and target prices in an investment strategy. One reason behind rising ATR is market psychology. After a period of calm price movement, there is pent-up buying and selling pressure among investors. For example, when an asset trades in a narrow range for a long time, both buyers and sellers await key breakout levels. When the breakout comes, trading accelerates, volume increases, the price starts moving within wider ranges, and ATR rises. This situation often signals the continuation of the trend or the beginning of a new trend. One of the most common scenarios when ATR rises is that the price moves strongly with large candles in a short time. These candles can sometimes push the price to significant levels within hours or days. If this move is upward and the trend is strong, investors can take advantage of it to gain high profits in a short period. However, because such fast moves can also happen in the opposite direction, the market should be closely monitored when ATR is high and stop levels should be applied with discipline. ATR's ability to reflect volatility makes it indispensable in trend-following strategies and breakout strategies. This is because it is rare for a strong trend to continue without an increase in volatility. When ATR rises, price movement is expected not just in small fluctuations but in large moves. Therefore, a rise in ATR is one of the most important signals in technical analysis that the move has started. In short, a rise in the ATR indicator is a strong sign that the price is becoming volatile and sharp moves are about to begin. This carries both opportunities and risks. With the right strategy, such periods can open the door to significant profits for investors, especially if the price makes a strong technical breakout while ATR is rising. This indicates that the move is confirmed and momentum is high. If investors can open and manage positions in time by taking this signal into account, they can turn periods of volatility to their advantage. In Elliott wave theory, the third wave is generally known as the strongest and fastest advancing wave in the market. This wave represents the point at which investor psychology and market momentum reach their highest levels. If a sub-third wave forms within the third wave and this sub-third wave carries the price to the 4.272 level, it creates a highly notable scenario from a technical analysis perspective. This is because it demonstrates how powerful the wave magnitude and momentum are. An extraordinary increase of 560% not only indicates the presence of a strong trend, but also signals that market participants are almost unanimously focused in the same direction, creating significant buying pressure. According to the Elliott wave principle, the third wave can never be the shortest and is often much longer and stronger than the first wave. Therefore, a third wave reaching the 4.272 level shows that the price is broken through a very strong area both geometrically and psychologically, reinforcing investor confidence. During the price movement toward this level, buyers tend to see every pullback as an opportunity, creating constant demand in the market. This allows the price to recover quickly and continue upward despite corrections. In such a bullish scenario, the nature of the price movement is generally impulsive, meaning it moves strongly in the direction of the main trend. Impulse waves are wave formations in which the market advances powerfully in the main trend direction, and the third wave is like the peak of this formation. Especially when a third wave forms within another third wave at subwave levels, it multiplies the momentum of the movement. Therefore, a move to 4.272, corresponding to a 560% increase, reveals that both Fibonacci projections and intra-wave momentum are far exceeding expectations. In Elliott analysis, third wave targets are usually calculated with the 1.618 Fibonacci extension, but since we are talking about a 560% increase here, this is a super trend situation where targets extend to 2.618, 3.618, or even 4.236 Fibonacci levels. In such a case, the market can also be positively influenced by external factors such as news flow, macroeconomic indicators, or sector developments. As investor confidence in this momentum grows, they increase their positions, causing the price to rise even faster. Third waves within third waves are often compared to a rocket launch. The initial thrust is provided by the first wave, there's a slight pullback in the second wave, during which the market gathers fuel, but once the third wave begins, this energy is suddenly released and the price surges upward, breaking resistances one after another almost without pause. At this stage, technical indicators usually enter overbought territory, but this does not necessarily mean that the price will fall immediately. On the contrary, in a strong trend, overbought conditions can persist for a long time. This leads investors to focus more on the strength of the trend rather than technical signals. A 560% increase also means that psychological barriers are being broken one by one. When the market surpasses certain round number levels, investor emotional responses come into play. These reactions either bring new buyers into the market or prompt existing buyers to increase their positions. If the news flow also supports the move positively during this process, the market reacts almost in a chain reaction. Each new high creates more confidence than the previous one, and when this confidence combines with crowd psychology, it accelerates the price movement. There is an important rule in Elliott wave analysis regarding the third wave. The third wave cannot be shorter than the first wave and is usually the longest. This rule applies strongly here, as the 4.272 level and the 560% increase are far beyond the strength of the first wave. During this process, trading volume also typically peaks in the third wave. High volume confirms that the trend is healthy and strong. An increase in volume shows that buying pressure remains consistently fresh and that sellers are withdrawing from the market. When volume rises alongside a steep price climb, it signals that momentum is at its highest level. This is why in the third wave of the third wave, the price reaching the 4.272 level indicates an extraordinary rally in the market. In such rallies, the probability of the trend continuing is higher than the probability of a correction, because market psychology has not yet reached saturation. One of the greatest advantages of Elliott wave theory is that it helps us understand the structure of price movements. This makes it possible to anticipate such massive rallies in advance and take the right positions. In the third wave of the third wave reaching 4.272 scenario, the most important thing investors should do is not underestimate the strength of the trend. Many investors tend to think the price has already peaked during such sharp rises and sell early. However, those familiar with Elliott wave analysis know that this could only be the middle of the trend and thus hold their positions. This allows them to achieve much higher returns in the long run. Such a strong movement is usually based on multiple factors. A favorable technical structure, supportive fundamental data, and market psychology concentrated in the buying direction are among the main factors. When all these elements combine, a rapid multiplication in price becomes inevitable.
A third wave reaching the 4.272 level remains etched in investors' memories as an unforgettable rally, and these levels later become strong support zones. A gain of around 560% is an example of great significance not only from a technical analysis standpoint, but also in terms of investment psychology and market strategies. This is why in Elliott wave theory, the third wave of the third wave is one of the most valuable opportunities sought by investors. Its strength, speed, and technically predictable structure allow those who catch it to benefit from the most profitable part of the trend. High targets like 4.272 and a 560% increase clearly show how lucrative this opportunity can be.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.